Reportedly, OPEC Plus will consider raising oil production yet again. A meeting is due on Sunday. The group is anxious to regain market share. We're joined by Jason Schenker, president of Prestige Economics. Jason, we haven't talked for ages. Thanks very much for joining us.
Great to be here, Andy.
It's always interesting, isn't it? OPEC, of course, thinks decades ahead, and their overriding mission is not to lose market share in the global oil market. So if they raise production, that can discourage new entrants.
Well, it could discourage new entrants. I mean, I think OPEC's looking at a couple of different things. One thing they've been more concerned about in recent years was the green energy transition and electric vehicles taking market share. And now I think maybe their market share priority is a concern around countries like the U.S. and Canada boosting their oil production levels to meet global demand, potentially squeezing out OPEC's share of that market. So on the one hand, before they're worried about oil in general as a share of energy consumption globally, but now very specifically worried about how their oil production may lag behind. But this is a very tough time to consider boosting production. Oil prices have been under a bit of pressure. And of course, if we think of OPEC as the central bank of oil, they also are looking at today's weak jobs numbers, wondering what does this mean for the future of growth? And could they be about to increase production into a market where growth could come under further pressure, both in the U.S. and globally?
Saudi's Crown Prince Mohammed bin Salman is set to visit Washington in November, and presumably his host, President Trump, would be happy to see measures to reduce oil prices.
Well, that's one thing, right? Like pushing oil prices down is good for inflation, right? By helping to reduce it. But on the other hand, there are a lot of oil and gas companies in the United States, and the U.S. is a net exporter of product. And so if you push down prices too much, that's going to hurt a lot of American businesses and both U.S. and Canadian oil production and refining industries.
We, of course, in Canada, were pumping more and more Alberta oil. Earlier this year hit a record high Alberta oil production.
Yeah, absolutely. I mean, Canada's become an increasingly important part of the global ecosystem for oil production. The U.S. as well. I mean, North America has become a really dominant force. And of course, this is something OPEC's keeping an eye on. But with oil prices where they are, adding a significant number of additional marginal barrels could apply additional downward pressure. And that could be something that, while it might hurt the private sector and in terms of North American production, reduce investment and result in lower increased production levels, you could also see that hurt OPEC member countries. So they're in a tough situation where OPEC Plus wants the price higher, but they need to make sure that they don't drive the aggregate price down, because at the end of the day, the profit of any business is the quantity times the price. That's going to be your total volume. Well, if you increase your quantity, okay, that's good. But if you push the price down a lot, then your total revenue might actually end up lower.
Can we leave it? What is your prediction? I know this is very tough, Jason, but for oil over the next year, is it going to stay stuck in the low 60s, given that these production increases seem to be on the way?
I think we're going to see oil prices be through the end of the year between 60 and 65 a barrel. But next year, I see them for WTI between $65 and $70 a barrel, because interest rate cuts are likely coming from the Fed, weighing on the dollar. Supporting growth that could push up oil demand domestically. We also see some important global manufacturing PMIs have improved in Europe, in China. We could see global growth improve next year. That's also in line with IMF forecasts. Next year, global GDP expected to increase from 3% this year to 3.1% next year. That could drive up oil prices a bit higher, especially around the U.S. summer driving season, but that really depends on Fed rate cuts and the U.S. job market and growth holding solid and continuing to expand.
Jason, great to hear from you. Thank you very much indeed.
Thank you, Andy.
That's the one and only Jason Schenker, president of Prestige Economics.